Subhi Gokran, Director Research with Brookings India and former Deputy Governor of Reserve Bank of India, joins us live. Mr. Gokran, good morning. Thank you for joining us. Sir, whereas no one is surprised with the direction of rupee move, everyone is surprised with the compression of Indian currency. Do you think now rupee has a stable bottom in place, because rupee in last 24 hours has appreciated by about 3% plus?
I think the immediate provocation for the very sharp depreciation on Wednesday was what was happening in Syria and the prospect of a conflict erupting in the Middle East. And that fear seems to have abated somewhat for now. I don't know how it's going to play out over the next few days. But that impact is clearly now reversing, and I think it is finding some level that takes into account the other factors that have been influencing it so far. On the external side, the tapering prospect; on the domestic side, the current account deficit. So we'll probably see it find some level that reflects the combined impact of those forces. And I think what we have to worry about, which the Syrian episode clearly demonstrated, is that if there is another external shock, whatever it may be, whether it's from Syria or somewhere else,
Let's talk about Indian economy and the GDP growth. Today, Q1 GDP data is due. Do you think the number could be closer to 4% rather than coming close to 5%?
Well, I've been out of the projection business for some months now, so I don't really have that precise an assessment. But I think from in a qualitative sense, very clearly, there aren't any significant signs of a turnaround. Certainly in the industrial sector, because we have whatever we have on the IIP, giving us a sense of how this quarter is going to turn out for that sector. Services had shown some decline in momentum in the last quarter, and I think that is probably going to be the story here as well. And the one perhaps boost that may come is from agriculture. So I really don't see it being very different from the last quarter in terms of any indication momentum, but I obviously cannot put a precise number on it.
Mr. Gokran, yesterday in his exit speech, Governor Subbarao attributed it all to growth moderation, to tight policy, saying that it's inaccurate, unfair and misleading as well. He said that economic activity has slowed on a host of supply-side constraints and governance issues. What are your reactions?
Well, I think that is an absolutely fair assessment, but the point he made was that there was always some expectation that tight monetary policy would result in some slowing of growth, because that is the way tight monetary policy works to contain inflation, that you compress demand because you feel that demand is driving inflation. And so you would expect some slowdown in growth as a result of the monetary policy stance. But the slowdown that we saw far exceeded anything that could be attributable to the high interest rate regime. And I think the point he was making was that a number of factors that had an impact on growth were really outside the control of the Reserve Bank or the monetary policy process. And so it is unfair to attribute the entire decline to tight monetary policy alone. And of course, the two factors that he mentioned, one, that we've had very significant supply-side constraints. Food has been a big issue. More recently, we've started to feel the pinch on minerals, on electricity, given that it is related to coal. We have a lot of capacity, but generation is clearly being constrained by the availability of coal. And governance, essentially, in terms of new capacity, projects being cleared, something which obviously the government is trying very hard to address, but has had an impact over the last couple of years on investment activity, which also contributes to the slowdown.
So what is the need of the hour then? What can the central bank, along with the government, do to help save the economy, stabilize the currency at all?
I think the immediate pressure, and particularly as it's reflected on the currency, is the current account deficit. And I think we need a very explicit and very so there's a credible, convincing strategy that that addresses the current account deficit. There are 4 stress points on the current account. 2 are well known, and the other 2 are being talked about more and more. These 4 are oil, gold, coal, and iron ore, and all of them, as a result of either very high, sharp growth in imports or a sharp decline in exports in the case of iron ore, have been huge contributors to the build-up of the current account deficit over the last 2 years. So if we have to address this, then we have to address each one based on appropriate instruments, policies that will directly deal with the constraints that they're facing. For oil, it is essentially right pricing. That's the only way to go to ensure that whatever conservation incentives there are in the system, that people are paying the correct price for the fuel that they use. On gold, it is a matter of what I would call dematerialization, which is to create instruments, to introduce instruments in the market that allow people to invest, find the attributes that they are now finding in gold, but without the need to physically import gold. And we have one instance, for example, in inflation-linked bonds, which, if people believe gold is an inflation hedge, this is one way to deal with it. There are other instruments that are related to gold but don't require physical import. We have to experiment with those. On iron ore and coal, it's really a matter of getting the domestic supply going, and there are obviously judicial implications here, but they have to be addressed, because if we don't address them, then that is going to impose pressure on the current account, which no other factor, no other solution will be able to offset. So I think we need this 4-pronged strategy to address the immediate pressure. And when that happens, many of the other implications, the other repercussions of sharply depreciating currency will ease off. Then we get the competitiveness benefits of a lower currency. We get growth going up, so that the fiscal pressure is eased off somewhat, particularly also with the fuel subsidies going down. So a number of good things happen from that. It's not an overnight solution by any means, but all of these elements have to be brought together to address the problem.
The government, Mr. Gokarn, has been talking about reworking the oil subsidy math and a possible one-time steep diesel price hike as well. Would that work in a scenario like today's?
I think it will. Signaling is very important in a scenario like today. If any action that is out of the ordinary is taken and that it is in the right direction, then it acts as a very powerful signal of commitment of the government to solve the problem. So what has been happening over the last several months is a 50 paisa hike a month. Obviously, the gap has become very wide now. It's gone back to, I think, the period, in fact, may have exceeded the period before this 50 paisa a month process started. So a sharp hike would say, okay, we're at least getting that process back on track. We're trying to narrow the under recovery, and that is a signal of commitment. So I think moves like this, they're not in and of themselves complete solutions, but they help to instill confidence. They help to provide sort of some goodwill, some credibility to the government as it works its way through this situation. So these measures, I think, are extremely important, and if they do that, I think it will have a very strong positive effect immediately.
Mr. Gokarn, let me ask my next question to the Director of Brookings India, not the former Deputy Governor of RBI. Do you think if Reserve Bank of India 1 month ago would have not intervened in the rupee market, and if they would have not considered monetary tightening, rupee would have not fallen so much? What disturbed the market was the fact that central bank was trying to defend the rupee and the attempt was half-hearted.
Well, you know, that's a nice separation, Nikunj, but I'm not yet in a position to make it completely, perhaps in another few months. But let me provide an analytical perspective on this. There are 2 ways to stabilize a currency or to make it more expensive relative to another currency. One is you increase the supply of the other currency, which means expanding the dollar pool. And that happens by raising limits on FDI investment in debt and so on, or a sovereign debt issue, which is something that's being talked about, or an IMF program, which is also something that's been talked about. The other is you reduce the supply of the domestic currency. Obviously, if you reduce the supply of anything, it becomes more expensive, and this was the approach taken. It's more predictable, it's more within your control. It has collateral implications. It obviously raises domestic interest rates. Now, each of these has some benefits vis-a-vis the exchange rate, but each of these has different implications vis-a-vis risk. What was done introduced an element of growth risk in the system by raising domestic interest rates. Had you done something else, it would have raised an element of external risk by increasing your debt exposures. So in this scenario, there's really there's no solution that does not come with significant risks and costs, and a choice has to be made. Now, you could argue, well, once a choice was made, was it articulated effectively? Was the intent communicated quite clearly? The consequences of the expected outcomes. I think one could debate that and say, well, maybe that process could have been handled better. But in terms of the technicalities of the choice, these are both legitimate choices, and one of them was exercised.
Let's talk about the famous red lines. The finance minister again and again has explicitly indicated that, look, I know my red lines for the CAD and for the fiscal deficit. But things have changed now. Crude is at 110. The crude import in India is at an all-time high now. Do you think it will be not difficult but impossible for finance minister to stick on to his red line definition?
Well, I think the issue is not that the finance ministry does not have control over this process, because it can, as it did in 2012-13, in the second half of the year, very sharply compress expenditure. And we know that there's a lot of money in the system which is allocated, but for various reasons, sometimes because of structural constraints, sometimes because of inefficiency, doesn't get spent. So as you come towards the end of the year, you realize that all of this unspent money is available in a sense for budget tightening, for belt tightening. So that opportunity is there. I don't know how much there is, what the extent is, and can it offset the full impact of higher oil prices and a lower rupee on the fuel subsidies in particular, and also on the fertilizer subsidies. But that opportunity is there. So if a red line is drawn and you say, look, I'll do it under any circumstances, then as you see the control over the subsidies and so on slipping because of these exchange rate and fuel price effects, oil price effects, then you obviously have to look harder and harder for opportunities to cut spending. Now, so you can achieve the number, I think. I don't think that achieving the number is that much of an issue. The issue is, what do you cut and what consequences do those expenditure reductions have on the system, particularly, and I think this is very important, particularly if the cutting is done on capital spending, on the money that is being allocated to create assets. And if that happens, then I think that proves to be a setback to the overall infrastructure development strategy and so on. So you've got to be a little careful on the balance, and everything has consequences. We cannot ignore or dismiss that fact.
Mr. Gokan, really appreciate you taking the time out and speaking with us. Good to have you on the show as always.